Hey everyone, it's Rob B here with Rob D, and you are going to be listening to a bumper-filled episode on the market update. Of course, it's a budget special, but we have loads more to bring you beyond that. And people who invest in holiday lets, I'm sorry, you're not going to like this episode.
Welcome to the Property Podcast. Thank you for joining us. This is where we take time out from advising a multi-million pound property fund and doing over £100 million worth of property deals each year to bring you some of what we've learned along the way for free. And this week, yes, if you're a holiday let owner, you do need to remember that we're reporting the news. We're not making the news because you're not going to be happy. But if you invest in property in any other way, there's actually some good news for you coming out of the world of politics for once. So do stick around for that and stick around all the way to the end because in Hub Extra, I've got some tips to help you grab a bargain outside of property.
So it's a budget special on Property Hub this week. We have loads of other news stories to bring you as well, but we have to start with the budget. And it is the last budget we will have before the next election. So it was a big budget, and it was a budget that will impact us all. How much so? Well, let's find out. And particularly, let's find out for property investors. Because, Rob, a lot of budgets have gone by over the last few years where property investors haven't been impacted in one way or another. But this time, there is definitely an impact.
Yes, there was. It's very much a good news, bad news situation. Good news for a large number of investors, bad news for a smaller group. So let's start with the good news. Rob, did you have a tax cut for property investors on your budget bingo card? Because I didn't.
No. That was definitely not on my bingo card. But I'll take it.
Yeah, and it's not a big one, but it's something. So it's capital gains tax. The top rate of capital gains tax on property was 28%. So sell any other asset, 20%. Property, screw you, 28%. Well, not anymore. It's fallen down to 24%. So still higher than you'd pay on disposing of other assets. But hey, that is officially a tax cut for property investors. And that is not something you see every year. But the Chancellor giveth and the Chancellor taketh away. So if you are an investor in holiday lets, this will not have been one of your favourite fiscal events because the furnished holiday lets regime is over. From April 2025, the special advantages that holiday lets have benefited from will no longer apply. What does that mean? Well, basically two big things. The first is when it comes to furniture and equipment, which previously you could write off against income as capital allowances and therefore reduce your tax bill. Nah, not anymore. And the other was that owners of furnished holiday lets could claim the full cost of their mortgage interest as an allowable expense, which of course individual owners of buy-to-let property cannot. That has now been brought back into line, so you won't be able to do that anymore. Rob, we've said on the show multiple times that we saw this happening. It felt like an anomaly that was going to be corrected. The bad press around holiday lets pushing out local people meant that this was on the cards. But still, to have it happen, there's a lot of people who'll be very unhappy about this.
Yeah, it was on the cards, but it wasn't leaked that it might happen in this budget. So it still came as a bit of surprise on the timing rather than the event happening itself. I get a feeling that this is the beginning rather than the end of attention for holiday lets investors now. I'm not going to say it's now no good as an investment strategy. That's a bit extreme, but it's certainly got the attention of the government and others, which we will come to shortly. But before we do, let's wrap up the rest of the news from the budget because there was a niche form of stamp duty relief for multiple home purchases. Now, this really only worked, let's say if you were buying a block of apartments, you could get a slightly more favourable type of stamp duty if you did, because you could link them all together. That has now been removed. There haven't been many investors that have taken advantage of that in the past or were planning to in the future. We actually have, so it's a bit of a shame for us, but I don't think anybody's going to be crying into their pillows in the evening for the people who are buying lots and lots of property in one go. And that pretty much wraps it up from a property point of view. Away from property, you'll now get an extra £5,000 for your ISA allowance, which can be invested in British businesses. This is an interesting one. There's not too much detail out on it yet, so we have to understand what exactly this is. But I'm sure most people would welcome it. How many people will use it, we'll see. The child benefit banding also changed. It was previously at 50,000 and that's been increased to 60,000. National insurance has also been decreased. That was the marquee announcement, really, of the budget. Not, interestingly, though, on income tax, which I think the government had the ambition of doing, but just couldn't make it work. And actually, if you look at the amount we are taxed overall, because of the band freeze on income tax for a few more years, it means that what we pay as tax as a proportion of income is pretty much the highest it's ever been. Rob, how do you feel about this budget? I want to break it into two parts. One, as a property investor, and two, just as a citizen of the United Kingdom who is impacted by everything that was discussed.
Well, from a property perspective, no particularly strong feelings. I'm glad that they didn't do anything crazy to try and juice the market up. There was talk about 99% guaranteed mortgages. Glad that didn't happen. And while I don't like stamp duty as a tax, I think that when that's removed and the way that's removed, it needs to be done very carefully. So I'm glad they didn't have some big flourish around that as a way of trying to win votes going into the next election. And I don't own any holiday lets, so no bad news for me as an investor in this budget. So from that perspective, I will definitely take it. In the more general sense, I don't know. I didn't see anything in there where it's like, wow, this is a real showstopper. This is going to change everything when it comes to the next election. But it was all a bit of sleight of hand, really, because like you mentioned, the tax take is higher than it's ever been before. The proportion of GDP taken up by tax is at an all-time high. And as a result of this budget, it's actually going to get higher. But because they previously announced even bigger tax changes, which they're now rowing back on, he gets to present it as a tax cutting budget. So like, as a result of the budget, you'll be paying less tax. Well, it's like, no, we're going to be paying less tax compared to some other future scenario, but actually more than we are today. But hey, if I was in that position, I'd probably do the same thing, because what's he going to do? He doesn't really have any leeway to cut taxes for real, which is what everyone would actually want. So I guess, Rob, to summarise, no particularly strong feelings. And as an investor, no bad news is good news. What about you?
Yeah, on the property side, it's business as usual, really, unless you're a investor in holiday lets. The capital gains tax thing is nice, but it's not a game changer. And really, when it comes to a budget, less is more when it comes to property. You just want to be left alone. And as far as budgets go, again, unless you're a holiday lets investor, it was an okay one. Looking at the wider economy in the country as a whole, it's a bit underwhelming. Underwhelming, especially when you consider this is their last budget before we go into an election. So this is where you think they'd push the boat out and be as bold as possible. And you're right, Rob, they can't be that bold because of where we are at the moment as a country and the state of the economy and our finances. But then you have to ask yourself, how did we get here? Whose fault is that? And I was just left feeling a bit disappointed. If that's the best they can do, if that's the last hurrah before they go into election, then it doesn't make me feel excited about them giving us the next budget either. In the interest of balance, though, the Shadow Labour Chancellor has said that it will be a slow start for them and it won't be anything radical when they come to do their first budget as well, because they have to undo the mess that the Tories have done. That's me paraphrasing her words. And actually, the Tories took a few of the policies away from Labour that they said they'd do anyway. So I shouldn't be surprised at what was delivered, but I'm still left feeling a little disappointed.
So that is the budget. But there's been plenty of other news around this month as well. And indeed, more bad news for holiday let owners. You know what? Someone in government has had a bad experience at an Airbnb. It turned up, it wasn't clean, the bed wasn't comfortable. They have got it in for holiday lets, because as well as the tax changes in the budget, a new policy has been announced that planning permission will be required at a national level to turn a home into a holiday let. And there'll be a new national short let register. So don't worry, when this comes in, if you've got a holiday let already, that will already have permission by default because it's already there. This is just for the creation of new holiday lets. So the intention is that this will give local councils control. At the moment, there's not a lot they can do about the number of holiday lets other than try to bump up the council tax as some kind of disincentive. But otherwise, not a lot they can do. Now they will have the ability to refuse permission. So Rob, again, something we've spoken about before, this very much plays into a lot of the stories that we've seen about how local people are being pushed out of certain communities in areas like the Southwest or the Lake District where there are a lot of holiday lets. How do you feel about this story?
Oh, I know we've got a lot of listeners who invest in holiday lets, so I'll tread carefully, Rob. As I've said already, I don't think any of this has come to us, at least, as a surprise. And that I think there are a lot of people, and a lot of them listen to this show, who do holiday lets very, very well. I think, though, it had to happen because the rest of property investment has been professionalised, or the government is trying to professionalise property investment and drive out the amateur investors. And I think it was the last area, really, of amateur investors where people would just have a play at doing holiday lets. And you were dealing with something very special, just like you're doing something very special when you rent any property out. When you rent out a normal property, you're renting somebody's home. When you're renting out a holiday let, you're letting them have a special time, an important time in their year. And we only get a few weeks holiday each a year. So if there are amateurs operating and people have had bad experiences, which they almost certainly would have, you can see why this would happen. I'm sure that people would argue that it didn't need to happen. And I can absolutely get and understand that, because if they are operating professionally already, then they may feel this is overkill. But it's not aimed at you. It's aimed at the amateurs. It's aimed at those who have had a dabble at this and aren't treating it professionally. And those people do exist. So while I can understand that this is far from welcome for a lot of people who invest in holiday lets, I think bringing professionalism to the industry is probably a good thing. Whether this was the best way to do it, it's debatable. But the intention, I think, overall is a good one.
Yeah, I don't disagree. I do think that some of the difference in treatment between holiday lets and long-term lets is just an accident, in that because holiday lets were a different classification. They almost like sat there quietly while everyone's beating up long-term let owners and no one noticed they were there. So they were the same. Then everything got worse for long-term lets, creating this difference. And now the government suddenly realised they're there going, oh, hang on a minute, we can go and tax these guys as well, or do whatever. So bring them back into line by making things better for long-term lets is the route I would prefer. Obviously, that was never going to happen. So doing it this way makes sense. And as for the planning permission thing, I kind of get it, because holiday lets or second homes, because that is a situation where supply is genuinely taken out of the market. Obviously, if there's a flip between owner occupation and buy to let, the number of homes available to occupy is the same. You could argue about density of accommodation and blah, 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 but it's basically the same. With holiday lets, that's not the case. So having the ability to restrict that where it makes sense for the local area, I do get it.
If that wasn't enough, Rob, there's a little bit more bad news for investors in holiday lets, and I promise we're not picking on you, we're just reporting the news. But Leeds Building Society have said they will refuse to lend on holiday lets in areas where local councils consider the numbers too high already. They haven't been forced to do that, they're choosing to do that. It's an interesting move. It might be just a one-off, but it's interesting to watch and keep an eye on. And of course, we will keep you updated on the Property Podcast with our market updates each and every month. Rob, I can't believe it's taken us this long to get to house prices. Normally, we lead with this because there's a lot of news around it, and this month is no different. It's positive news this month. We're bringing you data from Rightmove, Nationwide, and Halifax. And first of all, let's look at Rightmove, where asking prices are up for the second month in a row, giving us a strong start to the year. So they were up in January by 1.3%, and they are up in February by 0.9%. So there's some optimism in the market, at least when it comes to asking prices. And asking prices is interesting because it's a leading indicator, but I like to know the results. I like to look at the real deal, what's actually happened. So Rob, let's start with Nationwide first, because we do see positive numbers there as well.
Yeah, well, Nationwide and Halifax, in fact, both reporting that prices are up, and my prediction for the year is looking good. So if you want to dive into the detail more, be my guest, but that's what I take away from these stories.
Well, let's at least give people the numbers.
Oh, okay, let's give the numbers. Fair enough, I will do that. So according to Nationwide, prices up 0.7% in February. So the number that's being reported is that over like a 12-month rolling basis, we're now back in positive territory again for the first time. So that gives you an annual change of 1.2%. So this figure is making the headlines more than it had done in previous months. And Halifax showing the same kind of story, prices up by 0.4% in February, and the fifth monthly rise in a row. Now, I joked about my prediction, but on the whole, Rob, this is not supposed to be happening. According to almost anyone you could pin down for a quote, house prices were meant to be going down by somewhere around 3 to 4% this year. That, of course, could still happen. There's a heck of a lot of year left to go. But the year is not starting as if that's going to be the case. So this feels like it needs a special episode to me.
It does. So let's do it, Rob. Let's commit to that special episode. Let's bring it out next week. Next week, we will bring you a special episode on house prices where we ask, what on earth is happening? That's what we will ask next week and attempt to answer. And of course, with the Property Podcast, we will be doing more than just giving you the numbers. We'll give you the understanding. We'll give you the knowledge to understand why the numbers are doing what they're doing. And maybe just as important, give you the information you need to be able to have a good read on what will happen next. So that's next week's episode. Make sure you don't miss that. Another thing, Rob, is not to miss is Property Hub Select if you get the chance to join. Because normally we talk about mortgages in the market update, and we brought a mortgage expert to Property Hub Select last week. And it was a great event.
It was. propertyhub.net/select is the place to go to find out more if you have no idea what we're talking about. But yeah, we got together. Nick gave a little talk and had a Q&A. And it was super interesting because he obviously sees what's going on in the market every day and is talking to lots of people on the inside. And he seemed positive about a couple of things. He seemed positive about rates coming down, although not dramatically, but also positive about fees coming down. Because the big kind of like headline thing that everyone knows has happened is that interest rates have gone up, mortgage rates have gone up, but arrangement fees for buy-to-let loans in particular have got really, really high over the last couple of years. And he believed that they will start coming back the other way as well. Something else he mentioned that I thought was really interesting was that he said that 60% of the cases that he's put forward have been downvalued over the last year. So if you've experienced down valuation, you are not alone. It's something that's really, really widespread. And he talked about the challenges of like how to navigate that and what to do about it. And as you've seen, properties are being downvalued, but house prices are not falling. They're actually going up. So there's an element here of surveyors trying to predict the future, which I don't entirely disagree that they should be trying to do. But the point is how surveyors feel about the market is an important factor, as well as what the market is actually doing. And if you look at the last few RICS surveys showing the sentiment of surveyors, that's been improving over recent months. So Nick didn't say this, but that proportion of deals being downvalued, I think we might see start to fall. But it was a really, really interesting talk. And because mortgages are so important, we will be having a broker on the show to update us on what's going on in the world of mortgages in the next few weeks.
It's a big episode this week because we're ending with another big story, which is the rental boom could be finally over. So while property prices have started to push on a bit, rents have eased off, and by quite a bit. So in the final quarter of last year, Rightmove has reported that rents went up by 0.2%, which is the smallest level of growth since 2019. So the pace has definitely fallen off by some way. And if that continued for the rest of the year, it would go up by less than 1%. So that's definitely not a boom. Of course, we haven't had any data for this year yet, and we will report on it when it comes. But that is the final set of numbers for last year. It means that overall last year, rents were still up by 9.2%, which absolutely is a boom. But will we have a rental boom this year? I'd say unlikely. Unlikely looking at these numbers. We'll have to go back and review what we said, Rob, for our predictions. But looking at these numbers, if this trend continues, the rental boom is over. I think we can call the end after Q1's data. So we will report on that when we get it. But that is definitely a softening. And actually, it needed to happen because booms can't happen forever. Rents have gone up considerably. That's helped investors out when interest rates went up. Interest rates have settled. So rent settling as well is probably fair enough. And I'm sure a lot of tenants will be happy that the boom is over as well.
Yeah, I seem to recall that you went lower than I did in terms of rent growth this year. And I think you're going to be right because I do agree that it's over. And in my little pocket of London, at least, I don't think it's too strong to say collapsing. Way, way down. So many reductions around here. I don't know how widespread it is. Maybe listeners who keep an eye on areas elsewhere in London can write in and let us know. But if it is affecting more than just the half mile around where I live, which is what I keep an eye on, then London, of course, being as big as it is, can put a big weight on those national numbers, which might drag them down further.
So that is a packed edition of the market update done. But don't run away because we have now a bit more, a bit extra, you could say. It's time for Hub Extra, the bit of the show where we want to give you even more value. And remember, this is backed up by our Property Pulse email newsletter, which is written by the fair hands of Rob D. What a newsletter that is. Make sure you subscribe. Go to propertyhub.net/pulse. That also is free. I know, unbelievable. The value just keeps going and going. But Rob, without further ado, what have you got for us this week?
So my Hub Extra this week is about eBay. Yes, everyone knows what eBay is. But a couple of times recently, I bought some secondhand tech stuff on eBay. So one of them was an iPad. I wanted an iPad, but I only really wanted to use it as a teleprompter, so I couldn't justify to myself paying full price. And obviously on eBay, you can get things like that cheaper, but there's a risk as well, because it's not like you're getting it from a shop or on Amazon. There's no guarantee. How do you know you're not going to get ripped off? Well, I've got 4 tips. These are things that I use to very safely and confidently buy kind of risky items on eBay, but do so in a way that for me removes all the risk. The first is not actually about risk, it's about convenience. So you can do a filter where you only see items that have got the buy it now option. I cannot be bothered with waiting around to try and watch the auction and snipe in at the last minute. Maybe you get it, maybe you don't. No, only want to do buy it now. So that's the first filter. Second thing is to figure out what the price should be. So sellers are not daft. They look at what other people are selling for. Items settle within a price band. So if you're looking at a particular, say, model of iPad from a certain generation with a certain amount of memory, with a box or not, or whatever it is, there'll probably only be about a £20 price band in which everything falls. If something is dramatically cheaper than that, there's probably something wrong. So I'd stay away from those ones and only look at things that are within the band of where prices should be for the market. Obviously, when it comes to the seller, you want to look at reviews. There needs to be a certain threshold for positive reviews. You'll have your own kind of tolerance for bad reviews, and you can kind of go in and look at the history to make sure they're not gaming it by buying lots of really cheap items to try and bump the rating up. And then finally, when you do buy, if you've got a credit card, use credit rather than debit card to get more protection. If you've got an Amex card, even better, because the protection is another level up. And if anything goes wrong, you can actually call them and talk to them, and they're nice. And you get some points as well. So those are my top tips for the most effective and safe way of being a cheapskate on eBay.
I love it, Rob. You love a deal on your property, but it's not just property. You love a deal anywhere in life, and including eBay. Okay, so going once, going twice, going 3 times. We are done for the episode this week. Thank you for joining us. Remember, next week we've got a really good episode on property prices and what is happening there, so make sure you join us for that. We'll also be back with Ask Rob and Rob on Tuesday, and on Sunday you can find us in the Sunday Times, where we will be answering your property questions in the home section. Until then, take care, have fun. Bye-bye.
Bye-bye.